In this week's update, markets rally on inflation and Fed commentary. Precious metals move to neutral, and this remains a tricky market in the short term. My name's Garry Davis, and as always, this is general advice only. And please remember to like and subscribe to the video. Interesting week, finished very strongly, and unusually, I'd have to say, because the inflation data came in above expectations. It was a bit lower. I beg your pardon. It was a bit lower than the prior month, but nevertheless above expectations. And the Fed made comments that you would have normally thought would be negative for the market, but the market didn't seem to be listening because the Fed was talking about reducing asset purchases. And normally, as we've seen over the last several years, every time the Fed starts talking about taking away the sugar bowl, the market turns its feet up, particularly the growth stocks and technology stocks. But in fact, that didn't happen. Now, technology wasn't one of the strongest sectors on Friday night, but equally it wasn't one of the weakest either. In fact, the weakest were the defensive sectors, utilities and healthcare in particular. So the only conclusion you can make is that the market doesn't believe that the inflation data is signaling anything in terms of a trend. So the market is on board with the Fed in that it's just transient and it's not going to last, it's going to go away. And obviously the market doesn't believe that the Fed's going to take away the sugar bowl either. So it's the only conclusion you could make. And so we ended up with a very strong rally, and the S&P finished above 4,500 points for the first time and set a new all-time high, and the buying went all the way into the close. So I found that Friday was really defied a lot of things. It defied the seasonality. We should be in a weaker period. It doesn't always happen, but the overwhelming odds are that August and September tends to be weaker. And we've still got the best part of 5 weeks to run in this period that can be a little bit weaker. So it still may unfold yet. There are many plausible concerns out there across all sorts of different areas. It's not just economic. There's obviously the issues around geopolitics and China and Russia and Afghanistan and the Middle East. So many areas on top of the economic data. But look, the market is what it is. I'm sure you've heard me say 10 times or more that you've just got to treat the market as they set up on the charts. And if it seems illogical, then so be it. That's what it is. American stocks, the S&P ended up 1.5% for the week, and Friday really capped off what was already a reasonably positive week anyway. The aggressive sectors led, and that's a really positive sign. And the US dollar did ease back a little bit. I don't believe, as we'll see on the chart, that it has invalidated an uptrend, but we'll see. The 10-year yield moves slightly higher to 1.31, but look, these are very minor moves. And the VIX is back down from 18 last week down to 16.5, so we're back into calm territory as far as traders are concerned. So here's the S&P. You can see we've had a pretty lengthy run now where it's just a couple of days down, 2-3 days down at the most, touches the 50-day moving average, and then it's off again. Same again here and here, and here it didn't even make it to the 50-day moving average. And you can see we opened the week strongly and we finished the week strongly. So looks very impressive. But I must point out that any chart, whether it be an equities chart or a commodities chart, when you get this sort of really smooth uptrend that's just one step backwards and then 3 or 4 steps forward, at periodic points you get a larger correction. So at the moment, these little moves here are correcting the short-term move, is correcting the move from there to there. But at some point, we will get a correction of this whole move from down here up to here. We just don't know when that'll be. This was the last time that it happened in September through to the end of October last year, where we got a correction of the bigger move. And that will happen again. Whether it happens in the next few weeks, time will tell. But just at the moment, given the seasonality, given the fact that we are quite extended, the index is about as far above the 20-day moving average as it normally gets. Might extend a little bit more into next week, but I just don't think the risk and reward at the moment is all that attractive. Now, the Nasdaq also broke out, set new all-time highs, and closed right up on the highs on Friday. But the real mover on Friday was the Russell 2000 for small caps. And you can see it surged nearly 3%. And I have to say that is really quite a positive. Normally, you don't see this level of positive action at this time of year in the small caps. And you can see the volume was really up as well on the ETF. So it can only be described as a very positive finish to the week. Now, the US dollar, we had a little minor breakout and then it immediately failed. So it's failed back into the range. But look, that happens often. So that in itself is not a bearish signal. We're still forming higher highs and higher lows. And so if and until we take out this low here, then from my perspective, the US dollar is still in uptrend. And that obviously then dictates a lot about what's happening in commodities. So that's the level to watch on the US dollar. Wouldn't want to see a close below 92.5. So that's pretty much the line in the sand for the US dollar. Now, as a consequence, our currency rebounded. We'd broken down. We haven't got back above this breakdown level yet, although it does look extremely positive. I'll give you that much. So quite a positive move in the Aussie dollar. But it could be we'll only rally to here and then turn over and resume the downtrend. Turning to Aussie stocks, we saw our dollar, our index was up by 0.5% for the week, but obviously, we'll have a pretty positive open, I would imagine, on Monday. We saw commodity prices, not only copper and other base metals, but also crude oil as well. The energy and material sectors were the weakest last week, so we could see quite an abrupt turnaround in both of those areas. So I would expect a fairly positive open in our market on Monday. Let's just have a quick look at that index and some of the sectors. So there's the ASX 200, but if we look at energy, you can see quite a negative week again for energy. Finance continues to work its way slowly higher, although we do seem to be losing momentum to the upside. Healthcare continues to be pretty strong. And there's materials that really got smashed the week before with the iron ore price. But I would expect that we'll see a kick up on Monday. Turning now to precious metals, and precious metals, as you know, I've been somewhat bearish on because of the breakdown in stocks, which normally lead the underlying metals. So that was the main thing that concerned me. But with the US dollar falling, gold turned around and went up $37 and finished back above 1,800 on Friday night. So that was quite a strong move. Silver is still losing ground to gold, which is interesting given the rising demand for silver for industrial and decarbonisation purposes. It opened strongly, closed strongly. We had a bit of weakness in the middle, but in the end, quite a good week for precious metals. And I think that one of the key things is probably 5 or 6 main drivers for the gold price. Currency is only one of them. So this is not just a US dollar direction story. But if the US dollar is going up, it's hard for gold to continue to go up as well. It has happened from time to time, but it just provides a headwind. And at the moment, for my position, I think the US dollar trend is still to the upside. It's not been invalidated yet. Precious metals, also the downside case certainly has been shaken because of the strength that we saw, and we saw rising volume in the metals stocks as well on Friday night. So it wasn't just a price move; there was some pretty good volume behind it. It's rallied back, as we'll see, in both the major miners and the junior gold miners. It hasn't gone far enough yet to invalidate the case, but it certainly causes me to move to a more neutral stance. Let me put it that way. So I'm not prepared to buy precious metal stocks at the moment, but I've moved from being reasonably bearish to neutral until we get clarification, as you'll see in a minute. So if we go to there's gold on the weekly, so you can see we did get down a couple of weeks ago. We got down to 1685, which was support. We've bounced very strongly off that support, but we really need to get above this level here, which is about 1835, to indicate that we're now going to get higher highs and higher lows. So that's another line in the sand. If we look at it on a daily, you can see strong on Monday, strong on Friday, a couple of days of weakness in the middle. That's where we sit with the gold price. And if you look at silver, we broke down, we've rallied back. We're just having a little peep over what was support that's now become resistance. So you could really just say that's line ball at the moment. So that's sort of not definitive at this point in time. I'll look at GDXJ in a minute, but just while I think of it, this is Bitcoin, which some viewers like to keep tabs on. We've had a strong move back up, and we're just getting some consolidation at the moment. Now, if we look at GDX, you can see we've bounced from support, but at the moment we're still in a technical downtrend. The 200-day moving average rolled over many, many months ago. The 50-day has been fluctuating up and down, but it's now below it. And the price is below both of them. So even though Friday looks impressive, technically this is still in downtrend. The price is below the moving averages, which has rolled over. That's it. That's the definition of a technical downtrend. And until that changes, until we get probably back up here around, I would say 36, you really need to move just above 36 to really invalidate the breakdown, and GDX closed at 32.6, so we've still got a bit of a ways to go. It's more definitive with the juniors, GDXJ, so clearly a breakdown. We've now rallied back to test that breakdown. That's not unusual. The volumes were good on Monday and Friday, so that's the positive, and that's why I've moved to a neutral stance. We haven't invalidated the trend, but there's certainly some signs there that you wouldn't want to be too bearish on precious metals at the moment. So I think just sitting in the middle is the appropriate place to be. Turning to other commodities, because the US dollar was down, naturally copper and nickel went up. But look, these currency impacts in the short term, they're really just noise. I think it's very, very clear what the bigger picture is for battery materials and industrial materials. It's it's highly bullish. We're moving into many years of significant deficits, and there's really nothing that anyone can do about it. Major discoveries are proving harder and harder to do, and major mines that are going to move the dial, that are actually going to make a difference to the deficit, you don't switch them on in 12 months. Sometimes they can take 10 years to go through all the processes and all of the permitting and the drilling and the financing and the construction, everything that's required. So years and years of underinvestment because of low prices are now going to play out with years and years of higher prices and deficits. So the outlook for the base metals market is very positive. Crude oil was also up quite sharply, and I can't help but think it was up a lot more than the currency impact. So I'm just finding the whole sector is proving very difficult. I don't like the long term. I find it extremely difficult to read. We've got constant currency changes. We've got geopolitical impacts left, right and centre. So I just find it a sector that it's hard to feel confident about. So I would rather just stay with areas that I think have much higher probability. And there's the spot copper chart, quite a nice rebound, similarly with nickel. So to wrap things up, trading is all about probabilities. It's about risk and reward. There are no certainties. That's all that we have is risk and reward, and it's just a matter of weighing up the risks as against the reward. At the moment, we've got an extended market. You put that together with a suspect seasonality time of year. I know that it doesn't always happen, but you just want to be a little bit more cautious. So I just think it's a bit of an undesirable short-term mix at the moment of those two things. And you don't have to be in there waving your arms trying to make money every day, every week. Sometimes it's best just to sit back a little bit, give things a few weeks to play out. If you can get into the market after some sort of more meaningful correction, and I'm not talking 15, 20%, I mean even 5% can set up some wonderful opportunities. And so the couple of weeks that you might lose now, you can make many times over by just being a little bit smarter about your entries. And I think that's where we sit at the moment. But other than that, I remain highly bullish in selected growth areas. Almost all of them are associated with mega trends that are going to continue for a long, long time to come. So I remain extremely bullish about the market. I'm just short term. I just think it's an appropriate time just to be a little bit more cautious. Portfolio analyst last week was a pretty big session. I did a lot of things. I provided some perspective on the next significant correction. So I am talking now here 20, 30, 40% kind of corrections. Whether we get one this year, next year, or not for several years, it'll come when it comes, but it certainly will. But the key point that I made is the magnificent opportunities that sets up for those that are prepared, for those that have got their list ready, that know what they want to buy, and they're just waiting for a big sentiment shift in the market to get the entries. And if you look at the opportunities that came out of March 2020, they were just phenomenal. The opportunity to double, triple, quadruple your money from those sort of lows in large cap, high quality stocks is really just amazing. We also looked at lithium, which is obviously just about the hottest sector on the planet at the moment. We also looked at ETFs that could be appropriate for the next decade as well. So a pretty good session in Portfolio Analyst last week. There's my website, which contains more information, and my email address. And for anyone that's not tried the Portfolio Analyst trial, it's available for $1 for a 2-week trial. There's a lot of education in there, a lot of very valuable perspective that I think a lot of people would get a lot out of. So that's it for this week. I'll be back with you next Sunday. Cheers.